Okay, hello everybody, and welcome to Investing with IBD, sponsored by MarketSmith. Today is June 17th, 2020. I'm your host, Arusha Pierce, and we have Ryan Worch on the podcast. Ryan is the founder of Worch Capital. Ryan, thanks for being here.
Thanks for having me. Really excited to get to it.
On today's podcast, we are going to talk about the current markets. We will talk about the importance of risk management, and then we will end the episode with 3 current stocks. Okay, so let's get into the current market. The market is an uptrend. It has been one of the strongest markets that I think I've ever seen. Only 2 distribution days on the NASDAQ and S&P 500, so pretty good on that front. We took a big hit last Thursday, but it seems like these markets are just very resilient, and it seems like we just come back very quickly. Ryan, what are your thoughts on this?
Well, really to back up what you said, this is probably the strongest rally off of a low we've ever had. In fact, going back to the 1950s, we studied the S&P and the rallies off major lows, and this is the largest rally ever off a major low.
Oh, wow.
The NASDAQ's rallied 42% since the March lows. Historically, we are getting a little long in the tooth. That's one thing we do watch. We watch a lot of statistical analysis. We follow it. We do a lot in-house. We read a lot of other people. In fact, one of the guys that I enjoy reading and I watch is Ryan Dietrich, and he pulls in a lot of data on this. Mm-hmm. One thing that he had mentioned, that the initial rally off of a major low lasts around 30 days. We are in day 60. So this is getting a little long in the tooth. It's also, again, the largest rally ever off of a major low. So we actually think that we are in the beginning of a bull market, not the end. Mm-hmm. And what's really interesting about this market is if you turn on the TV or all talking heads, everyone says it's overdone, too far, too fast. It's getting exuberant, euphoric even, but the data actually doesn't back that up. Of course, you can find anecdotal data that basically will tell you, yes, there are some extremes in the market. The put-call ratio is down to historic lows. The call buying versus put buying from retail investors is twice as aggressive now as it was at the February peak before the collapse.
Yeah.
And all the talking heads talking about Robinhood traders. But if you look at that, the retail environment is very small fraction of the overall volume in the market. So we prefer to focus on institutions, and I know that's what you guys like to focus on.
Right.
And they leave the volume footprint. And just recently, Bank of America, Merrill Lynch released their monthly fund manager survey, which we like to use as part of our data set and some of the indicators that we follow. And we find that their sentiment indicators are very useful. And what's fascinating about this market is that we've just rallied, the largest rally ever off of a major low, and only 18% of fund managers who are supposed to be the smart money expect a V-shaped recovery. Yet the NASDAQ is sitting at new highs.
Yeah.
The S&P is within spitting distance of a new high. 64% of these same fund managers expect a U or W shaped, and only 30% say it's a new bull market, which is fascinating. 53% still say it's a bull market rally. Now,
and let me interrupt you for 1 second there, because that brings up a great point. I feel like it's almost deja vu, because we had essentially a V-shaped rally at the beginning of 2019 too, and a lot of very smart fund managers were kind of saying the same thing with the V-shaped rally. Everyone's expecting a retest at the bottom. Now we've had even a little bit more extreme kind of rally this time around. So keep going, but it really is pretty amazing at how a lot of smart people have been fooled by this V-shaped recovery.
And I think it's going to continue to fool people. Listen, if you had asked me at the end of March, if I thought the NASDAQ would be at new highs 2.5 months later, I probably would have put the probability at 5%.
Right.
But the market doesn't care about my opinions. So I have to trade the market that I'm presented. I could sit here and bitch and moan about all the reasons why it shouldn't be here, or all the potential pitfalls and problems that may be associated with all the spending we're doing. But I'm not paid for my opinions. I'm paid to make money.
Yeah.
So again, we have to trade the market we are presented. And again, if we go back and look at the data suggests that we are potentially at the beginning of a bull market, not at the end.
Mm-hmm.
The one thing that was missing for me, and quite frankly, listen, I didn't get it right. I wasn't buying the exact bottom, but I did miss the whole down move. So I was a little bit patient getting back in. I needed to see some clues that this was more of a potentially successful rally than just a bear market rally.
Mm-hmm.
And for me, I really didn't get those until probably later March, even earlier May, when a lot of leadership started to exert itself. The beginning of this rally was very narrow. Very few growth stocks, quite frankly, were breaking out at the beginning of the follow-through day.
Yep.
I would say it wasn't really until probably April 13th when Amazon and Netflix both broke out in tandem, which are two major market leaders.
Yes.
That kind of kicked off the wave of growth. And then I'd even say probably later than that, when earnings started rolling around, sometime early May, you had breadth just explode in leadership. You had, prior to that, maybe a handful of growth leaders that were working. And I would say since early May, you have 100 growth type of leadership stocks that you could take a pick from.
Yeah.
And again, this is showing up in our data. I mean, the expansion of 3 months highs on the S&P is exploding and hit one of the largest readings ever. This only happens at the beginning of bulls. So this is characteristic of bull markets coming out of 74, 82, and 09. The same readings we're getting now were the same readings back then.
Wow, that's really interesting. It feels like the beginning of a bull market. A lot of stocks, they just refuse to go down. They just keep crawling up and really don't give a lot of people a chance to get into them. I wanted to go back to something you mentioned earlier about getting long in the tooth on average, a rally off the bottom. It's around 30 days. It's been 60 days. What happens usually, just on the average from those 30 days, after those 30 days, what generally happens after that? Is it just an intermediate pullback, just a rest for a couple of months?
So that's a great question. It's really interesting. So the average pullback after the initial thrust, the initial rally off the lows,
mm-hmm.
the average pullback is around 10.3%.
Okay.
Yeah, this is according to Ryan Dietrich, who I follow.
Yeah.
Now, Eric Kroll is another guy, fund manager I talk to, who does a lot of data analysis too, and we compare a lot of notes. And he did some work on the NASDAQ going back to 1980, and he was saying approximately 80% of the rallies end in 50 days or less. Again, we're at day 60 now.
Right.
So we're getting long in the tooth. But what's interesting about this is the market just corrected last Wednesday.
And that's what corrections are, it seems like, these days. It's just like a one-day, just a bloodbath, and then it's back to the new highs.
Albeit it was literally one day, but from peak to trough, it was probably a 2-3 day event.
Mm-hmm.
Now the S&P corrected 8.3%, the NASDAQ 6.8%, and the Russell 2000 13.1%, all within the normal averages of the average pullback. So, this had us thinking, did we get the pullback? Again, shocking that it was only a day.
Yeah.
But when we go back and look at prior bull markets, I even did a blog on this back in April, where I went and compared the current environment to every bull market since the 50s. We found in my firm that the most reliable precedent, based on a host of different factors, and you can go and read the blog, it backs it up, was the 1998 precedent.
Okay.
Where the market had this sharp sell-off, V-bottom, and was right back to new highs.
Yeah.
And what we found was essentially the NASDAQ followed the 20-day moving average all the way up. And what are we doing now?
Yep.
We're following the 20-day moving average all the way up. Every pullback has been limited. It's been short in nature, and it's been very, it has not been deep at all. And again, those are hallmarks of a strong bull market. And that's what we believe we're in.
Perfect. So Ryan, how did you get into this? You know, walk us through how you got into investing. You know, what inspired you to really take and move towards this path?
Sure. So I'll try and keep it short. I was a finance major in college. I went to Virginia Tech. I always had an interest and kind of a passion for the stock market. I remember growing up, my grandfather had a little black book where he wrote all of his stock buys and sells in, and we'd sit there, whether it was Christmas or Thanksgiving or Easter, going through it. And it just fascinated me.
Yeah.
In fact, you know, as a 12-year-old, for my birthday, I asked for a share of stock in Walt Disney. I don't know many 12-year-olds that do that.
No.
But
do you still have that share?
I do. I have it framed in my office at my home. And I keep it as a, you know, a piece of pride. And I still own Disney to this day.
It's beautiful.
It's far cry from what I do as a fund manager, but it's still neat to look back and think at, you know, 12 years old, I had an interest in this. So coming out of college, again, not many people know what they want to do. I ended up going and working for my family business, which is the electrical subcontracting business. It was my father, my brother, went to work for them, quickly realized it's not what I wanted to do.
Okay.
And my dad basically said, you know what, go do your thing, find your passion. We fully support you. One of my other brothers was working as a financial advisor and kind of introduced me to a couple people locally in the DC area. I ended up getting hired by a boutique broker dealer in the area. There was two brokers. One was an institutional, one was a retail manager that were just making gobs and gobs of money in the late 90s. This was during the end of the bull market, 99 going into 2000. And
right.
they needed someone just to basically help them with handling their clients. And I pestered them for months. And finally, I think they just gave me a job just to stop calling them and annoying them. So I got hired in the fall of 99. I ended up getting licensed, Series 7 and all that. So at this point, I was living at home. I was making, I think, $25,000 at the time. This was, again, in the fall of 99. I was saving as much money as I could. And I remember opening up a trading account I even went back and looked at my notes. It was called SureTrade.
Wow.
I opened up the account in May of 2000, which this was after the NASDAQ had peaked in March.
Perfect timing.
I had opened it up with $500 again, which was at that time all the money that I had and saved up.
Yeah.
I continued adding it as I was getting paychecks. So my strategy back then was just to buy whatever my bosses told me. You know, these guys were successful. I thought they were smart. And why shouldn't I listen to them? So I was just basically buying 50 shares, 100 shares of whatever they told me. And I started making money. And I, of course, thought this was easy. So at this time, I think I had about $4,000 in my trading account. And I had put, I think, 60% of my account into Nortel Networks. And shortly after I bought Nortel Networks, they released earnings. The stock gapped down like 40%.
Oh my God.
And I had I felt like I had lost everything I had earned. It was at that point I realized that I have to get educated. And I have to take things into my own hands, and I can't make money or trade my account listening to others and taking advice. So the firm that I worked for, they had a Bloomberg terminal, Wall Street Journal, The other magazine that they got, or newspaper that they got at the time, was Investor Business Daily.
Perfect.
So I just started picking it up and reading it, and right off the bat, somehow it just read to me almost. I got it. It made sense. And basically, I went on a fact-finding mission for the next 2 to 3 years, getting educated, figuring out that I don't ever want to have losses like this again and how to prevent them. Yep. And I think that's the beauty and the simplicity of Investor Business Daily and their system is they will get you out of every major market collapse. And since then, I've missed every major market move. And, you know, I will say I have to give Bill O'Neill and the guys at Investor Business Daily a lot of credit, because without them, I'd probably be in a different place right now.
Yeah, no, it makes a lot of sense. And we spoke about this a while back, but I have the same experience. It's once you learn how to manage your risk and learn when to stay out of the markets when they get in trouble, you're in a whole nother place. You have a chance to really build your account and really profit in those uptrends.
Yeah, I mean, I think, again, the hallmark of what I do, I prefer to say that I'm a risk manager first and making money second. But I feel like the easiest way to compound your gains is by not losing money first.
Yes.
So a lot of people don't understand the math behind it. Again, if you lose 50% of your capital, you have to make 100% just to get back to break even.
Exactly. And Ryan, let me hold you there for 1 second. Let's take a quick break. The market's in an uptrend, and as both Ryan and I have said, this is one of the strongest markets we have ever seen. So you want to make sure you continue to learn and try to figure a way to get into some of these stocks when they set up. But let's take that break. But when we return, we're going to continue this conversation. We are going to talk about risk management and how important it is. So stay tuned. I am here with Scott St. Clair. Scott's one of our senior product coaches at MarketSmith. Now, Scott, there are a ton of publicly traded stocks. Just on the U.S., I think it's over 5,000 stocks. Who has the time to go through all of these stocks and find the very best ones?
Yeah, most people don't, right? So what you need is a tool like MarketSmith. We have decades of research on what makes a great winning stock. So we've done all the research for you. So we're going to try to highlight those specific stocks with those great data points. So if you're looking for that next great potential big winner, orange stock ideas button, you just click on it and you've got some of the main reports that we use, including the Growth 250.
Yeah, and the Growth 250 is the first list that I go through on the weekends.
Yeah, it's the most popular one, but there are others. There's the Breaking Out Today, Stocks Near a Pivot, and then the Blue Dot list, right, which is very popular. It's going to show you the stocks with the best relative strength. So we've done a lot of the work for you. What you have to do is review these lists. You're going to come up with some of the best ideas in that current market environment.
Perfect. MarketSmith saves you time and makes investment research that much easier. For more information, go to investors.com/podcast2020. Ryan Worch is our guest on Investing with IBD, sponsored by MarketSmith. Okay, Ryan, let's continue the conversation. And now let's get into risk management, because as we both know, that is the most important step that you need to get down first before you really get into investing, or especially investing in growth stocks.
Yeah, correct. And, you know, as I was saying, the reason I made such an effort to find a strategy for myself that relied on not losing as much money is because I went through this painful period, albeit it was a small amount of money, but it was all the money I had at the time. Right. So I never forgot that feeling of what it was like to lose so much money so quickly. So again, I start everything from a risk management starting point. Every trade that I put on, I have a stop loss associated with it. Every day I go through my long book or short book, wherever I am, I know exactly how much I am going to lose in my whole portfolio if everything is stopped out. Mm-hmm. So again, I focus the majority of my time on executing my plan. I think that's really critical here. A lot of people that attempt to do this, whether they do it on their own or some even professionally, I feel like they're always jumping around to the next greatest thing. Whether it's trading penny stocks or the FANG stocks or the bankrupt stocks currently.
Right. Yeah. Like junk off the bottom, airlines and all that stuff, right?
Exactly. People, I feel like, are always trying to chase whatever's working. Well, I know my strategy, and I know it goes through ebbs and flows. There are clearly times when it works extremely well and outperforms. Now is one of those times. There's also times on the downside where it outperforms again. I got out of the market late February. I missed, actually probably early February, and I missed the whole move down. In fact, we were even up in March because we took some timely shorts. But if you go back, I started my fund in October of 2008. Again, my timing seems to be impeccable. I started my personal trading account in May of 2000, and I started my hedge fund in October of 2008. Yet it ended up being kind of a blessing in disguise, even though the fourth quarter of 2008 was the worst quarter in the S&P, I think, in the history of the S&P. It was a terrible time to start a hedge fund. But the beautiful thing about corrections is they create opportunities. So coming out of corrections, while they are hard to go through, and especially secular bear markets that last long, like the 2000 to 2003, that was 2.5 years of a grinding market lower. Yep. 2007 to 2009 was a grinding market lower. But because I highlight and make such a point of worrying about not losing money, it has saved me so much. I don't have to make as much money on the upside now because I don't lose as much money on the downside. Again, my largest peak to trough in my fund is 15%. Yet compare that to the general market, it's 50%. So if your biggest loss is 15%, you don't have to make nearly as much money to get back to break even if you're down 50%. So
that's the name of the game right there. In the end, that's it. You always have to stay within striking distance of your equity highs, or you're going to be spending a lot of time wasting that next great bull market just trying to recover your losses.
Yeah, digging out of the hole, exactly. And again, when I go back and look at all of the analysis on my fund, I think part of why I've been so successful is, one, this isn't easy by any means. No. You have to really work your ass off. You have to prepare. This isn't something that I do as a hobby. This is something I do as a business and a job. So I take it very seriously. So I spend long hours going through tremendous amount of data, statistical analysis. I analyze my own trading. I analyze my own trades. I analyze the market. I analyze the leaders. I analyze the losers. This all goes into, a thesis that I create that gives me a direction on the market. So it's not me just sitting here saying, oh, the market's in an uptrend, I want to be long. The market's in a downtrend, I want to be short. There's data that I have to back up this market is in an uptrend. Why is it an uptrend, and what is it showing us? Just like we were talking about earlier. I mean, the data that I look at is really telling me that we are at the beginning of this bull market, not at the end. Now, listen, I don't know if I'm right, and that's the beauty of being a fund manager is we are very flexible and can change our minds at a moment's notice.
Yeah.
I may love the market today. I may hate it tomorrow, depending on, what changes. And I think that's something that, I think the one thing that's constant in the market is change. It's always changing. And I think that's what's fascinating about what I do and what people in this business do is that we're trying to figure out a puzzle that is constantly evolving.
Yes.
Just when you think you have the puzzle pieces figured out, the puzzle pieces change.
Yeah, and just think about just think about even like 15 years ago, where markets, just in the market analysis, you might have like five distribution days, 6 distribution days, and it was a pretty good odds that you were going to corrections. A lot of great stocks were starting to fall apart. These days, it's a lot more resilient, or things, you see more V-shaped recoveries. Things just move a lot quicker, and there's just a different feel to the market than even just 15 years ago.
So, I mean, the saying adapt or die couldn't be,
Yes.
more appropriate for that, because it's not that I'm changing my strategy constantly. I'm just evolving to the markets. And that's a good point, because when I got into this business, the guys that I worked for were very smart. They were CPAs by training, so they had a fundamental bent more towards the value side, traded micro and small caps. But this was before Reg FD, and they were visiting companies, calling companies. And this is when you could actually get information when you called a CEO.
Right.
That game changed after the tech bust in 2000. New regulations came in, and you couldn't do that anymore.
Yep.
So you had to adapt your strategy based on that. Coming out of 2009, we had this whole thing called quantitative easing. And like you said, we've had really 5 significant sell-offs since probably 08. None of them have been lasting. I would say probably the longest one was 2011.
Yeah, that was pretty tough.
Yeah, that was tough. But we've kind of had the backstop of the Fed, and that's probably why we've had much more shallower and shorter corrections than previously.
Yeah, but it's also amazing, and I tell this to people who are newer to this. That buy and hold, and just holding on to your losses right now, those habits are being reinforced. When that market shifts again, and maybe when the Fed's not there to provide that floor, who knows how long that will be. But there are going to be a lot of people who have developed a lot of bad habits by not respecting risk management, by riding markets down from February down 50%. Now they're all the way back up. Now, look, I'm back up on my accounts now. They're going to find themselves in real trouble.
Yeah, and I think there's obviously clearly a battle going on between passive and active, right?
Yeah.
And the passive crowd is winning. They're banging the drum a little bit louder. They're marketing to everybody. They're saying, you don't ever need to sell. See, I told you so.
Yes.
If you had panicked at the lows, you would have missed this awesome rally. But I'm sure just as well as I, these things also go in cycles.
Yep.
And when like you said, the Fed is not there, the next bear market could be a 2.5 year bear market. We don't know. I have no idea. Again, part of our strategy, there's a timing mechanism to it, right? We try and get in and get out. We try and ride the lion's share of the trend. But nobody can consistently time the market perfectly.
Yeah.
You can't. It's impossible. But the market leaves little clues. And if you listen to the message of the market, you can adjust your exposure levels accordingly. And I strongly believe there's times where you don't need to be in the market 100% of the time. So while I'm talking my own book, I truly believe in active, but I also have the numbers to back it up. Mm-hmm. So, I think there's always a time and place for active managers. Again, listen, at the lows in March where the S&P was down 25% at the lows for the month, my investors were tickled pink that we were slightly up. Right. And it's funny because I started getting calls from everybody asking, what do I do? What do I do? What do I do? And for people that are just in these passive, asset allocation, I really can't tell them much. They really kind of have to ride it out. So you have to plan prior to the sell-off, not after the sell-off.
Exactly.
I think that is the major part of risk management, is having a plan and being able to execute the plan. Now, there's a lot of people that have plans and they fail to execute it.
Yes.
It's like it's like staring at a deer in headlights. Their account's down 5%. They're like, oh, it's going to come back. Yeah, it's down 10%. Most corrections stop at 10%. Well, then you're down 20%, and they start going, oh God. Well, now you're down 30%. They're going, get me out.
Yep.
And historically, we know most people panic at the bottom.
Yep.
And that's when they capitulate. That's when they get out. And that's when the opportunities are the best.
So talk about this concept, because when the market was coming back up, and you were waiting, you weren't in a rush. You waited for some more signals to come, more leaders to set up. Talk about the concept of waiting for the fat pitch, because that is another really key concept that traders and investors need to get down if you're following this system especially. But being really disciplined and waiting for those setups to emerge before putting your hard-earned money to work.
So, I think, Ted Williams said it best, one of the best hitters of all time. They asked him how he's so successful at hitting. And he says, I wait for a good pitch to hit. Very simple, but Ted Williams was actually way ahead of his day in his analysis of the swing, and when to swing and when not to swing. That's exactly what I feel like I try and do. I take a tremendous amount of statistical data and analysis, and I put it in and I try and shape a message and a thesis on how I want to position my portfolio. Now, I missed the whole down move. Again, I did not lose a dime from the market peak. In fact, my equity curve went up. But I actually lost money in April. How could that be? April had this strong rally. Well, I was being patient. I was waiting. And even though the market had a follow through in early April, I started tiptoeing back in mid-April. And I kind of got chopped up because I was kind of chasing it a little bit higher. So I was tiptoeing my way in because I didn't necessarily feel the rush to get in, because I didn't see the evidence yet if this was just a bear market rally or the beginning of a bull market. And since I was sitting on gains for the year, I didn't feel the need to rush it. I had the ability to wait for that fat pitch. Now, I got that late April, early May, when you saw an explosion in growth stocks gapping up, whether it was on earnings or coming out of sound bases on volume. Again, I tend to think that for really growth, it started April 13th with Amazon and Netflix.
Mm-hmm.
And then going into early April, once you had earnings, you had a handful of really good growth stocks breaking out of long bases on massive volume.
Yeah. And I almost feel like it was the kindest earnings season that I've ever seen. They treated everyone, every stock, at least for the stocks I own, they all went up, which is never happens, usually the opposite way.
And not only did they go up, they went up 10, 20, some 40% in one day on the biggest volume in the history of their trading.
Yeah.
So, that's telling you something. It's back to the old Bill O'Neill saying, that's not, your Aunt Susan buying, right?
Right.
There was some real institutional money coming into this market and buying growth stocks. And that goes back to, the data we look at. If you look at the fund manager survey, they had massive amounts of cash in April. They were putting that to work in late April and early May.
Yeah.
And they still have a decent amount of cash sitting on the sidelines, which shows you there's still potential for this market to even go higher because there's cash on the sidelines. The sentiment indicators aren't even remotely bearish. That's what's fascinating again about this market. After we've had this 40+% rally off the bottom, the largest rally ever off of a bear market, you can't really find a lot of bearish sentiment, whether you just go through fund flow data or AAII, fund manager cash balances. The Bank of America Private Client Sentiment Indicator is actually bearish. This is after we've had this big move.
Yeah.
Fund flows into bonds dwarf that of stocks. How could that be after we've just had one of the most historic rallies off lows? It's because people don't believe it. People are still positioned and still scared, and they hold cash. So maybe there is some more upside when that cash is put to work. Again, I have no idea where the market's going to go from here, but there is some evidence that suggests we could go higher from here.
Perfect. So risk management is everything, and if you use it properly, it will set you up for the next great market if you're patient. Coming up next, we are going to discuss a few ideas. Stay tuned.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
We are back with Ryan Worch on Investing with IBD, sponsored by MarketSmith. Okay, Ryan, let's get into a few stock ideas here. And the first stock we are going to talk about is CrowdStrike. And the ticker symbol for this is CRWD. So what do you find interesting about this stock right now?
So part of my strategy and the way that I look at the market, again, I come from a fundamental background. That's where I started at my own firm. And I really never forgot those roots. So what I try and do, and I try to establish themes, and then I look within those themes and see where are the leaders within those themes. Clearly, the biggest theme coming out of the coronavirus is the work from home, the e-commerce, the explosion in online everything.
Right.
Now what is, if everybody is working from home or working online more, what's going to be one of the most important things? And that's probably security.
Yes. And
CrowdStrike's one of those stocks. They're taking a cloud-based approach to security and replacing all these outdated, ineffective antivirus solutions. On top of it, they have beaten raise, I think, almost every quarter since they have been public. It's a new issue. It's only been public for about roughly 2 years. They're growing revenues at an 80% clip on a quarterly basis. That's fascinating for a stock this size market cap. If you look at it on a weekly chart, it had a huge cup-shaped base since its IPO.
Yep.
Massive accumulation within the base. Which is a hallmark of funds buying as the stock is correcting.
Mm-hmm.
And then on top of that, you had a breakout on earnings the last 2 weeks on a huge accumulation. This is a stock that I want to be long. Again, I don't know if you want to chase anything here. And this is not any advice or solicitation to buy or sell any stocks. And full disclosure, I do own this, and I do own some of the stocks we'll be discussing. But I think this is one that looks very promising for the future, and kind of along the lines of the theme that we're in. I think they're only going to get stronger, and they're going to be needed just as much as anything else as we come out of this, because I don't think we're going back to the way things were prior to it.
Probably not. Yeah, with the behaviors like you were mentioning.
Certain behaviors are going to change for good. And again, like I said earlier, the one thing that's constant is change. But we're living through this technological revolution now. It's such an exciting time to be a growth investor, because we're going through something that was eventually going to happen.
Yeah.
But what's happened is the coronavirus has expedited this that may have taken 3 years to 2 months. And there's going to be certain winners, and there's certainly going to be losers. And what we're trying to do is identify those winners that are going to be successful for the next 12 to 18 months if this bull market continues.
Yeah, perfect. Now, I do own shares of CrowdStrike too. The relative strength for this stock over the last few months is dramatic, and a lot of accumulation. So that ticker symbol is CRWD. Definitely worth adding to your watch list and see if it sets up maybe even just a little bit more traditional base, as it just went into new highs, but now is a little bit underneath at 4.9% below the 52-week highs right there. So let's go to the second stock, and that is Fastly, and this is one that I own also, and it is a really interesting story that I don't know if a lot of people are aware of. Ryan, why don't you talk a little bit about this one?
Yeah, I mean, Fast is another one of these new issues, came public May of 2019. But this is another one that's going to be a winner in everything going online. And Fastly is a leading edge cloud platform. So what is that? And I kind of, for research for this podcast, I went through and I read conference calls, and I do some fundamental research of reading research work. But I thought this was just such a good quote from the CEO. I wanted to read it directly from him. This is from their conference call from the earnings report in early May. It says the momentum from 2019 continued through the first quarter and was further bolstered in late March by increased traffic on our platform from social distancing and orders implemented across the world. The unprecedented times highlighted the importance of digital transformation now more than ever, and our innovative and resilient customer base enabled us to remain confident in demand for our mission-critical services and accelerated growth of our business. So there's clearly, again, going to be some winners and losers, and this is one of them. I think it's going to be a clear winner, as what that allows them to do is their customers to relieve their data faster. And who doesn't want that when there's more people, working remotely?
Yep.
Businesses working remotely. On top of it, they're growing revenues 30% or more last 4 quarters. It has from a basing structure, it has a nice long, I don't know if you want to call it a cup, a double bottom, but it basically consolidated essentially from its IPO in May of last year, and then just exploded on volume and price when they released earnings. I think it was May 7th.
Yeah, so 620% volume above average on that earnings report. And once again, that was not Aunt Sally that was buying stock at that point.
No, it has a 2.2 up-down volume ratio. It was the biggest volume in the history of the stock. So that's telling you institutions are getting long this. And even with such a massive gap up, you were able to buy this.
Yeah.
You could have bought this stock on the gap up. It's gone from 30 to 60 in the last, month and a half. So, you can't be afraid of chasing some of these things as they're breaking out, even if you think they've gone too far, because what we've also noticed, and we've gone back and analyzed the data, when stocks break out of earnings surprises, they tend to drift higher over time.
Mm-hmm.
And we want to be involved in them as they're moving up. And this is another example that we think is going to be a winner. Again, I don't recommend chasing it here because it has run very far, very fast. But this is one you probably want to keep on your watch list over the next, 12 months.
Yeah, and a lot of times when we look to buy out of bases of stocks that have settled down, one of the first requirements you look for is a strong prior uptrend. And if you look on a weekly chart for this stock, you don't really get much stronger of prior uptrend than this one. It is straight up, and it's been straight up for a while.
Yeah. And listen, IPOs are historically a little bit more risky.
For sure.
But that's where a lot of the new merchandise is, and a lot of the exciting companies, the growth companies, that's where they're coming from. They're these newer companies that have just become public that have these massive growth rates that we all love. And so you can't be afraid to dip your toes in the water on something that hasn't traded as long as, a Tesla or an Amazon.
Exactly. Yep. So you always want to try to stay on that cutting edge of some of these newer companies that are coming out, read about their products, learn about what makes them, successful. I think one of the big things with Fastly is their CEO has been pushing for SSD hard drives in all of their servers that they're using for years. So he was way ahead of the game instead of using the traditional kind of slower kind of servers. And that's what gave them kind of made it differentiate versus a lot of other services out there, which has enabled them to provide a lot faster services than a lot of their other competitors.
And that has a lot of parallels to what we talked about earlier about preparing.
Yes.
These companies that are they just didn't come up with these ideas. They've been preparing for this. What has happened is this pandemic has expedited it, and the people that were prepared and the companies that are going to adapt the fastest are going to be the biggest winners. And it's so many parallels to trading. It's unbelievable. Again, you have to be prepared prior to the meltdown, not after the meltdown.
Perfect. So let's go to one more stock here, and this is one that most will be familiar with. It's PayPal, ticker symbol PYPL. And what do you like about this stock right now in this company?
So PayPal is another one I want to highlight. Clearly, it's in a strong uptrend. It's a little bit slower growth than the prior two, but it's growing earnings year over year at 20% clip. From a basing structure, it's had a really nice long base that it's just coming out of.
Yes.
And what's fascinating about PayPal, again, back to my fundamental roots, on their conference call, their CEO said they had April was their best month since their IPO.
Oh,
that's
wow.
That's fascinating. And he basically alluded to that the U.S. is at a tipping point in e-commerce, and digital payments will only increase from here. And I don't know if you're seeing the same things that I'm seeing, but we are slowly working our way off of a cash-based society. I don't think we're ever going to get rid of cash, but more and more people are going to online payments, whether it's PayPal. PayPal owns Venmo.
Yep.
I know for me, which I never liked using that stuff, I've almost been forced to get on it.
Yeah.
I think every single one of our babysitters only accepts Venmo. So my wife is really the one who spearheaded this. And, that goes back to like the Peter Lynch model of, look at the things around you, talk to people. I talk to my kids, I talk to my wife, ask them what's exciting, what are they using? And, I never even heard of Venmo prior to them telling me it. And again, once I did my research, I realized how powerful this could be. And PayPal, I think, is going to be one of the winners coming out of this. And the price and volume action is really confirming that.
Yeah, and talk about price and volume, it reported earnings, and it had a massive jump as a result on the reaction right there. And let's see, it was 200% above.
Yeah, look, it traded over 30 million shares. I mean,
Exactly.
That's the heaviest it's traded in years.
Yeah.
Again, that is institutions getting in. This stock has done nothing but drift higher since then. So institutions are gobbling up. I think this is one that's going to be another winner out of this pandemic, and one that I'm going to keep on my watch list and probably own at some point.
Perfect. And I do own shares of PayPal too. So there are a few ideas that are worth adding to your watch list. Thanks, Ryan, for joining us today.
Thanks, Rich. I had a great time, and hopefully we can do it again.
Next week, we are going to have Kathy Donnelly on the show. Kathy is a prop trader and author, and also, like Ryan, a longtime customer of IBD and MarketSmith. We know Kathy very well over the years, and she is another excellent example of being a student of the market and seeing success over time. So that's it for this week on Investing with IBD. I'm Arusha Paris, and thanks for listening.